Dear friends, wish you a very happy new year. It is that time of the year when it is good to reflect on what has happened in the year gone by and what to expect going into new year. 2023 has been a very interesting year. India navigated the external environment really well. Notable events that shaped the trajectory actually included Fed's strategic pivot, BJP's decisive victory in state elections, and also there has been a reduction in global risk premium despite all the global upheaval that has affected global crude oil prices. India's performance actually stood out during the year. Let us now get into some of the key events that transpired in calendar year 23. A very important event was about how US economy has played out during the calendar year. US economy actually surprised positively on the growth front. For the year as a whole, it is expected that US economy would grow close to about 2.5 to 2.8%. This versus expectation when we started this calendar year, or rather calendar year 23, was that US economy would get into recession somewhere around Q3 or Q4 of the calendar year. A very strong growth actually came from how US consumer has spent, how US investment activity has played out by the corporates, and also US government spend on defense. This has led to pretty decent growth in the US economy. Hard landing discussions are no more on the table. Also, when we started calendar year 23, China's reopening trade was a very important trade that many of the participants tried to play. However, the opening actually turned out to be a really bad one. Despite reopening with optimism, the year unfolded with economic chaos within China, with initial enthusiasm actually giving way to lack of confidence among consumers, home buyers, corporates, and also investors. And sentiment actually got significantly worsened by significant loss of value of major Chinese tech companies like Alibaba and Tencent. Chinese economy may slow down further, reflecting the fragile recovery from coronavirus-induced setbacks, pain in the property sector, which we believe is very deep. Also, weak global demand is also playing impact on their exports. Consumer confidence there is low, and also there is significantly higher level of debt in the Chinese economy. Another important aspect that played out was about inflation in Japan. Inflation in Japan actually continued its uptrend in 2023, providing opportunity to Bank of Japan to actually take incremental measures in policy normalization. New government didn't bring about radical policy reversals owing to growth risk and also rising probability of inflation towards the 2% goal. However, the yield control curve policy has actually been implicitly abandoned as the concept of yield cap was let go on 31st October meeting. This is a very important event that may shape up world economy. Another interesting aspect that played out was about how crude oil has reacted in last calendar year. There were output cuts by OPEC. There were also tensions in EMEA regions, right? And these events actually were expected to push crude price higher. While crude did go up close to about $95 somewhere around September 23, demand side impact actually being on a lower side. Also, other factors like Chinese and global economy kept the upside in check, and prices receded to about $75 per barrel by the start of December 23. This actually has provided significant relief to emerging markets. US crude oil output also had impact on crude prices, even after the potential supply disruption owing to geopolitical tensions involving tensions in Red Sea, a key oil trade route. A very important aspect that has actually been discussed for a while, especially after COVID, was about inflation. Calendar year 23 will be remembered in global macroeconomic policy as a year when inflation scare of 2022 was tamed in major economies except Japan. Receding supply chain bottlenecks coupled with fast pace of rate hikes by central banks and base effect aided global inflation moderation. China slid into deflation. Western developed markets are witnessing gradual moderation towards their 2% target, while Japan's inflation started to moderate of late. Among emerging markets, India did witness transitory spike in inflation as food prices rose due to erratic weather conditions. However, Range-bound crude movement and moderating crude core inflation suggest durable to risk to inflation actually remains at bay. In the upcoming year, on the growth front, we expect India's strong growth rate to continue in fiscal year 24 and 25 as well, in spite of a slowdown in global growth that we may witness. India has very solid tailwinds in the form of pretty range-bound crude prices, very solid credit growth, and also very high focus on public and private capex. On the monetary side, we may possibly see a rate cut from RBI in calendar year 24, as we see possibility of inflation durably staying at 4% unless crude oil plays a spoilsport. Amidst this backdrop, we remain positive on following themes. We are seeing a very monumental changes in manufacturing. Indian manufacturing sector has witnessed strong growth this year, banking on various global and domestic factors. A very important theme that is emerging is about decarbonization. This is a big area globally, and focus here can be on various value chains of energy generation, transmission, distribution, energy storage, hydrogen ecosystem, electric vehicles, and many more. Also, supply chain globally is seeing significant dislocation. As many companies globally look to reduce their dependence on one nation for their operation, India, along with few other countries, actually stands a very good opportunity to cash in on to this change that we are witnessing globally. India has a very large domestic market, and this allows confidence by corporates for capex as well. And there are multiple supportive factors which actually can have very solid effect on overall manufacturing ecosystem. We have a very large supply of manpower, whether it is intellectual or whether it is even labor intensive. Even policies by government has actually been really supportive. PLI actually is looking to spur up investments into the country. Also, government has focused significantly on supply side economics. Government capex has been rising and has been providing required stimulus for the growth of the economy. Multiple areas where government has spent includes airports, roads, railways, ports, and we continue to believe that overall government capex will continue to grow. Rise in government capex actually has also been having a crowding in effect, reviving the private sector investments. Private sector investment has actually lagged for last 2 years. However, we are already starting to see improvement in capex by Indian corporates. Top 500 listed companies, ex of financials, have actually increased their own capex by close to about 49% in fiscal year 23 versus fiscal year 22. So overall, we believe manufacturing is one area where things are altering and altering from a very long-term perspective. Another area that has been doing really well for a while may have taken some bit of a pause at the current juncture, but remains a very long-term theme is about consumption. As many developed economies are moving into an era where demographics could be a cause of concern, India actually has entered into the era of reaping the benefits of demographic dividend. Japan was the first country to get into spiral of degrowth in population. Many European nations, along with others, including China and Britain, are also towards a similar situation. This demographic shift actually will be marked by higher population of old people in these countries, with a relatively lower working age population and a relatively higher median age. In such a situation, India stands across a huge opportunity, as it is the most populated country in the world along with the largest workforce. India has hit the demographic sweet spot, and many countries in the past have reaped the benefit of that, and India is expected to continue to do the same. Further, we believe a close parallel can be drawn among India's current demographic landscape and that of Japan in 1970s. Japan witnessed pretty solid growth in the following year, which transpired into a very strong market returns as well. With the benefit of demographic dividend, it is expected that India's per capita income would also rise pretty steeply from the current juncture. This should translate into higher consumption, especially on the discretionary spending side. Thus, the consumption sector, especially the aspirational one, will be major focus for the Indian landscape. There is very limited penetration among many of the discretionary products in the Indian markets, and there exists huge potential of growth in this area. For example, air conditioner has just about 8-9% penetration, washing machine close to about 14-15% penetration, and refrigeration about 35 odd percent. So penetration led growth in area where aspiration level is high should continue for a length of time. Another area which we believe which is a very integral part of the overall ecosystem is about financials. Last 5 years, non-food credit growth actually has been quite tepid. It grew about 9%, and that has been largely because of a very limited, very small 4% growth in the credit side that we saw for industry or manufacturing segment. Services and retail loan did register a pretty decent growth of about 11% and 12%. The share of manufacturing in the incremental credit during this period was a mere 13%. However, we are now seeing a change there. Private sector capex sanctions have actually increased by 80% during the year. Sanctions typically trickle down into actual disbursement over following couple of years. Banks and financial institutions have always dominated the capex funding space, with fiscal year 23 share at 76%. With interest rates in the developed world being significantly higher, it is possible that the share of banks and financial institutions may actually go up further in coming years. System credit growth for banks is likely to sustain at 14-15% range, as spike in sanctions will actually lead to higher disbursements. Within the project sanctions by private banks, there is a clear skew towards large ticket sizes, especially those which are more than 5,000 crore and above. Consequently, the average ticket size of loan is also expected to go up over next 2-3 years. While tailwinds are very high for the Indian markets, valuation at headline level appear to be on higher side. Specifically, the mid-cap and small-cap index are trading at a decent premium relative to the Nifty. Assuming no disruptions, we believe markets from here on would closely monitor earnings growth trajectory of businesses. Post the recent state election, policy continuity is expected, and markets would closely watch for uptick in private capex cycle. Also, we believe rural consumption is challenged currently. Incremental deterioration has actually stopped. And with the expectation of inflation not surprising negatively, we should see improvement in rural part of the country as well. Some early signs of that are already visible now, especially when we look at two-wheeler sales, which has actually grown pretty decently well in this festive season, gives some confidence that rural economy has actually turned the corner.